Good day everyone. Welcome again to one of our video recording session in strategic cost management. And today we will discuss financial and non-financial performance measure. This is chapter 15 in your reference. Okay, the expected learning outcomes are the following: measure performance from a financial and non-financial perspective, design an accounting-based performance measure, compute return on investment or ROI, residual income or RI, economic value added or EVA, and return on sales ROS. Specify the difficulties when comparing the performance of division operating in different countries. Okay, as we have learned in our previous lessons and also as discussed in the previous chapters, performance evaluation or measurement is very important for managers at all levels for them to gain information about the performance of tasks within the firm and judge whether that performance are uh, in compliance with the pre-established criteria as set out in the budget or in the plans or as the goal of the or in the goals of the organization. Now, the following are the purpose of performance evaluation: to motivate the managers to provide a high level of effort, to guide them to make decisions that are congruent with the goals of top management, and to provide a basis for determining fair compensations for managers. So, that is how important the performance evaluation is. Since the performance evaluation will serve as a basis for determining the uh, accomplishment of a manager or a certain unit, it is also important to set the benchmark or the indices to be used in assessing the performance, whether it will use financial information or non financial information, or a combination of both. Now, in our previous lessons, we have learned about some tools or means to measure both financial and non financial information to assess or evaluate the performance of a unit or the entire operation, and that is through the use of a balanced scorecard. So, one means to evaluate a performance of a manager or a unit is the use of a balanced scorecard. The balanced scorecard provides emphasis on uh, information about both internal and external information or measures, such as stock prices, amount of total sales, or amount of income, or amount of cost. It also integrates non financial information, both from external and internal as well. Example of which are manufacturing lead time, speed, numbers of defects, or even registration of new patents. But for this chapter, we will be focusing on more on about financial performance using accounting-based performance measure. Okay, so the following are the steps in designing an accounting-based performance measure. First is choose among the different performance measure. That is, you need to identify which particular uh, performance measure you are going to use to assess or evaluate a certain unit or the accomplishment of a task of the management. Now, normally, a unit managed by uh, a responsible person is expected to produce an output or an income or generate a cash flow which will add to the total income or cash flow of the entire organization. And so you may use ROI or return on investment on a particular unit or division, or the residual income measure, the economic value added measure, or return on sales formula. And then the next step is to choose the time horizon of the performance measure. An evaluator could measure a certain unit or a division using a single year or a multiple years. It depends on the situation or the evaluators or the purpose of the performance evaluation of which time horizon will better fit the need of the management. But here are some of the reasons why it is better to use multiple years as a basis for time horizon. Number one is to avoid using single year or short run changes in performance measures that could run counter with the long run goals of the firm. That means the resulting measure on a particular year may be applicable only on that year and may not be true uh, in the next year or in the following years. Hence, it would be best to measure multiple years as compared to a single year. And then number two reason for choosing multiple years is the benefit of an action taken or implemented on the particular year may not show up in short run performance measure. So it simply means if a manager would implement a policy, the benefit of that policy may not be evident on that particular year and may only be evident after that year or maybe in the future years. And so it would be better to use multiple years in evaluating that particular unit. Also, if a manager used the net present value method to make investment decision using multiple year residual income to evaluate managers' performance achieves goal congruence. Since the manager uses the or considers the time value of money in investing on a particular unit, it would be best to measure the performance of that unit using the residual income on a multiple year basis because of the consideration of the time value of money. The expected cash inflow, which was supposed to be received in the future or after that particular year, may lead to an incorrect interpretation or incorrect significance of that residual income. Hence, it would be better to use multiple years if the management uses the net present value method. The next step is uh, to appropriately choose the definitions for each of the elements of the performance measures that you will use. Say, for example, you opted to use return on investment. You need to properly and appropriately choose would you define the term investment. Or if it is, or if you opted to use return on sales or residual income, you need to properly and appropriately define the total assets or the total investment that you will use in determining the value of the performance. So, for example, the term total asset, it may refer or it may means total asset available, which includes all asset, even though some of the assets are not used in the operation, such as those properties acquired for purposes of accumulating wealth. Or total investment or total asset may be interpreted or defined as total asset employed, which include total asset less those assets that are idle or purchased for future expansion. In short, uh, in using this kind of definition of your total investment, you only compute for the return on those uh, operating or used assets. Or you may use total assets employed minus current liabilities, which is defined as total assets excluding that portion employed that are financed or total assets employed that are financed by short-term creditors. Or you may use the term shareholders equity, and the use of this term combines operating decision made by managers with financing decisions regarding equity made by corporate management. The next step is to choose which uh, cost will be used for the valuation of your assets or the valuation of your investment. You could either use the current cost or the historical cost. This will have a significant impact on the interpretation of your computation, say for example of ROI, because when you use the current cost for your ROI, you are considering the current economic value of the investment in relation to the generated income or return as compared to its original cost or its historical cost. However, there are some drawback when in using current cost because some of the assets that need to be converted in its current cost are difficult to estimate simply because it will require some technological advances to determine its correct current cost as compared to its historical cost. It is also important to recognize the impact of the use of the current cost when those investment or the component of your investment have different lives. Say, for example, you have assets which are acquired uh, years older than the other assets. So when you measure the return on investment, it may not reflect the true value of your investment. Hence, it could either be higher as expected or too low as expected as well. Another decisions that you need to do uh, on step 4 is to choose whether you will be using the gross book value method or the net book value method for your long-term assets. That is whether you will consider the accumulated depreciation incurred in the past to reflect the current value of the long-term assets. Now, in choosing between gross and net book value, you need to understand that depreciations are estimates of decrease in the value of the long-term assets due to time or maybe due to usage. Hence, if it is just an estimate, it may still be subject to error or incorrect judgment. And so you may either use the gross book value or the net book value for your long-term asset. The next step is to choose the target levels of performance. That is setting the index or the benchmark where your computed ROI, RI, or EVA will be compared. So at this point, you need to appropriately set that standard so as not to make a wrong impression or wrong interpretation when you compute your actual ROI or RI or EVA. That is, you might be able to uh, incorrectly or inappropriately measure the distance between your benchmark or your criteria and the value of what you have computed. So you need to set the target levels appropriately. That is something that is feasible rather than impossible to attain. And the last step is to choose the timing of feedback. And that is setting a standard of when you need to receive the feedback, either from, I mean, either to the top management or the middle management. It is important because some critical information needed by the top management or the middle management are expected to be received by them for them to make uh, the appropriate decision or a timely decision as well. Also, in the choosing of the timing of feedback, it is also important to determine as to whom the feedback to be uh, sent, whether directly to the top management or it should be to the middle management first before going to the top management. And also, you need to set the uh, process or the means of transporting the information or the feedback to one level of management to another. So, the more sophisticated the system used in transporting the feedback from the operation to the middle to the top management, the more critical it will be for the top management and the middle management because they need it on a timely basis. Next is an evaluation of a company that is operating on a multinational level. For these companies, the performance evaluation might be uh, very complicated as compared to those domestic companies operating in one single country. Simply because there are factors that are present in the international level and not in the local level. So here are the following reasons for, reasons of making the evaluation of multinational companies uh, different or difficult and complicated. Number one is complication brought about by legal, cultural, political, economic, and social differences across countries. that direct attention to special areas or restrict a local manager's action. So, for example, the manager of a division in other country might have some restrictions on the person himself or the manager himself, or they have restrictions on the operations of that division. The government imposes restriction on the operation of that divisions. So in that case, the performance of that division might be differently measured as compared to other division in other country. Multinationals must cope with changes in exchange rates, issues of inflation and fluctuation in foreign currency. Exchange rates affects performance measure and over which the local manager has no control. That is actually true when uh, the multinational company would use a blanket rate or a blanket process of measuring the performance of each division, even if you are operating in other country. So, say for example, they are using a blanket measurement of uh, return on investment or ROI. They would simply uh, get your total net income in your operation and convert it in the currency of the head office, and it might happen that the exchange rate between the division's uh, currency and the currency of the head office is lower as compared to the currency used in other country, in other division in other country, and the head office. And therefore, it will also affect the performance of that particular division. Another reason is that availability of materials and skilled labor, as well as cost of materials, labor infrastructure, may differ significantly across countries. So, say for example, you are being evaluated based on the cost of your manufacturing or cost of production. Uh, if you are operating in a highly paid labors in a country that labors are highly paid, then your production cost is expected to be higher as compared to those country with uh, laborers who are paid less as compared to your country. So therefore, the performance is also affected. Companies may have problems in setting transfer prices considering the different tax structure and currency restrictions of the countries in which their divisions operates. That is also true when there are certain taxes imposed on your division which are not imposed on other divisions located in other countries. Important controls, examples tariff and custom duties, and limiting selling prices of a company's product may be imposed by government in some countries. And that's another reasons for making it more complicated to measure multinational operations, divisions operations. Uh, some countries are restricted to uh, sell their products according to what they have computed by adding a markup on their cost because of restrictions in the selling price imposed by the government. Another concept that we need to understand is there is a difference between the performance of the manager and the performance of the organization that he managed or the unit that he managed. Meaning, the performance of the manager may be separately evaluated with the performance of the unit that he is managing. Now, in evaluating the performance of the manager, it is important to consider the following. Because of uncertainty in the manager's environment, the evaluator should recognize that other factors inside and outside the firm also influence the outcome of the manager's effort and abilities. Say, for example, breakdowns of machines, uh, fluctuation in the market prices and demands. So these are factors that affect the performance of the manager despite all his effort to achieve his targets. The evaluator must include only factors that the manager have controls, and because of uncertainty also and lack of observability, that is, the efforts and decisions made by the manager are not observable by top management. A risk averse manager is improperly biased to avoid this issue and with uncertain outcomes. Meaning, it is normal for managers to be afraid of or anxious about making any decisions, especially if the manager is a risk averse person. But it is expected from him to make a decision, and that decision is not observable by the top management. Hence, despite this dilemma, uh, the evaluator uh, did not or wasn't able to measure the degree of difficulty that the management or the manager experience in making a decision. And lastly is the intensity of incentives. Since management are expected to make difficult decisions, especially decisions related to day-to-day operations, it is but uh, proper to compensate them fairly and justly. Now, on the mind of the top management, uh, these managers should be compensated based on their performance. Hence, if that is the concept or the idea of the top management, uh, managers would probably make a better performance for them to receive a better compensation. So, the more sensitive the performance measure, the compensation provided to the managers, the more uh, it will provide pressure or motivation to the managers to perform better as well. Okay, so that's it for this topic. I have a separate discussion on the computations of ROI, RI, and EVA.